Alright, so welcome back to another video on how to secure yourself financially. Looking at the Morningstar Investing Classroom, and Morningstar is this North American financial firm headquartered in Chicago, and it was founded by Joe Mansueto in 1984. And it provides a range of investment research and investment management service. And sorry, educational content, financial educational content. So because they have several cores, they feature content, stocks, portfolio, bonds, ETF, funds, and ESG, the environment, social, and governance. Well, right now I'm looking at the featured content, the first course, and inside of this, understand each one of those sections. Staying investment in the market. I'm going to make a quick recap of the things to know that stock has provided the highest return and increase in the wealth over time. Investors must have discipline and patience when it comes to look at when it comes to saw the performance of the crisis and long-term performance in the market, the stock market. Holding on can pay off in the long run. See how the small cap stocks, which means is stocks whose market capitalizations is between 250 millions to 2 billion. That's the range according to Investopedia. And uh, that after the end of a recession, these small cap stocks, on average, the accumulated return perceived by this outperform those of the large stock after the end of a recession. After 1 month, 6 months, a year, and 3 years after the end of a recession. And also look at what is the interest rates, understand what is this loanable fund market where we have different interest rates, or which is, yeah, in the loanable fund market we have different interest rates. The cost of borrowing or saving you earn. In the so in this loanable fund market they have several interest rates for loans reflecting different risk and timeline. So once I look at the uh, ya creen que por ser así. So so after I saw is the interest rates in the loanable fund markets, there are different interest rates reflecting loans of different risk and timeline. I also see a couple examples of short-term interest rates. And by short-term, we mean is 1 year or less, okay? Such as Treasury bill, the federal fund rate, which is that rate used by commercial banks to lend fund each other overnight, and how the U.S. Federal Reserve tried to regulate the economy by setting the discount rate, something I'm going to talk about later, setting the discount rate, the prime rate, the rate at which commercial banks charge to their most credit worth client, usually corporations, and It also monitor the overall national banking systems, create monetary policies, prints money as well, and buy and sell securities in the federal open markets. And the security, which they are fungible financial assets that hold some monetary value, so depend on the perspective of it can entitle the owner to some part of the company, or it can entitle the owner to own uh, something from a company, and they usually call stocks, or that this security entitles the owner into a principal plus interest, and they usually call bonds, right? So the beauty of this is this financial instrument, this security, allows to transfer wealth through financial markets for the most profitable uses, allegedly, right? And because the things to know here is that the Federal Reserve tried to achieve the uh, federal fund rate by buying and selling government security in the federal open market, or securities. By buying and selling securities in the federal open markets. So since the bond market is also affected by the state of the economy, much like the stock market, the interest rate is determined in the bond market is determined by the demand of loanable funds. So during an expansion, the demand for loans tends to increase as the interest rates. During a contraction, the demand for loans decrease as the as their interest rate. So that's this second section of market downturns and recovery, to get a broad perspective of how the market performs is important, especially if you, as an investor, wants to have long-term investment and see how the risk decrease over time. So looking at this 49 GIF examination of the past capital market return from 1973 during the Yom Kippur War until 2021, in the middle of the pandemic, okay, I was able to saw that they have been 10 market downturns, or contraction in this case, that each one of them, after each one of those contractions, it marks the end of a stock market cycle, meaning a complete round of a stock price security fluctuation. So these contractions are explained, or this the contraction means when the stock market value peak fall from 10% or more. And this can happen at random times and may last for a different period of time. And the recovery, uh, or the expansion, okay, it measures the recovery of an index from the very bottom of the contraction to its previous peak and the subsequent performance until the next peak level before 10% decline. So the recovery here is the the upswing, or the boom in the security price following a long decline. The term is also to describe the nations, or the boom activity economy in a nation, or on yeah, in a nation, or on a nation. And Be able to understand this, and also what an index means, which is this statistical reference of investment expressed as a percentage, that the whole idea of this is to measure progress. Okay, so by looking at the market contr- contraction and expansion, and then at the market in terms of recovery, which is the thing that struck me the most, because I see how the U.S. equity market has passed through several uh, crashes, and the most severe start at the Great Depression, when the stock lost over 80% of their value, specifically 83.4%, and the recovery period took 12 years. Question is, did you have 12 years to recover, right? And more recently, in early 2000, when the stock lost 44.7%, the recovery took over 4 years, and it was the second largest in history. And then on 2007, 2008, uh, the stock lost 50.7% of their value. hmm Yeah, it lost 50% of their value, and the market took over 3 years to recover. So even though at each one of those instances that the recovery has shrunk in time, uh, now since I'm living is this coronavirus uh, that affect the state of the economy. So this is one of the reasons why I set this uh, course, or this is one of the reasons why I set this recording, not only to improve my communication skills, but also to understand real factors that are in that are valuable to myself and to the market. Right now, there are some couple concepts here. For example, like equity. So what means U.S. equity? So equity means, or the total amount of assets minus its liabilities, the net worth of a company, or the capital, the amount of shares you own from a company, or in the context of property, the total value of a property minus its liens, and which is a legal right of someone else to possess your property until an obligation is met or a debt is repaid. Now, there are several types of liens, such as bank liens, uh, judgment liens, real estate liens, mechanic liens, and tax liens. So bank liens uh, are liens that are put to any loan you ask to for a bank to buy, for example, a uh, yeah, to buy, for example, a or to purchase a car, right? So when you ask a loan to a bank for a purchase, to purchase a car, the bank automatically issue a loan for that in case you're unable to repay them. So they seize your car, resell it, and repay the debt. The judgment liens are a legal claim that a judge can issue to seize your assets, and this is common on lawsuits where a judgment liens can allow a defendant in a non-payment case to seize and liquidate some of the accused assets or all of the accused assets. You also have mechanically, which is a guarantee that the owner is going to pay builders, contractors, or construction firms for service offered. And if they're not able to pay that or they're not willing to do that, you can file a lawsuit in a court uh, and to get now this judgment liens, right? Then you have is the real estate liens, where you can seize the real estate property of someone else if a contract is not fulfilled. For example, when you ask a mortgage to a bank, they automatically issue a liens on that home in case you're unable to repay them. Okay? And then you have is a tax lien. Because in contrast, that other type of liens that are created by a contract, these are created by the law. And this is very, very common in the field of taxation. So, for example, if a U.S. or if a taxpayer becomes delinquent and is unable to or willing to uh, give signal that they're gonna pay that, the IRS, this tax authority, can issue a legal claim on some of the or all of the assets or all of the taxpayer all of the delinquent taxpayer assets, whether it is their home, their vehicles, or bank accounts. Again, this is from the last resort. And when that happens, they make a public auction or a sheriff auction where they sell all of these assets to gain uh, or and to repay the debt. Right now, the funny part of this is, uh, yeah, you might kick off someone off the system, but after all, you need them to get it back. This is one of my questions, that what is the redemption step? What's the redemption path for this kind of person? There's no redemption, right? That's a question. There is no redemption. And so once I look at the liens, right? Then I go back to the market downturns and recovery. After I saw is the market contraction and expansion. The things to know this is that investor should have a long-term investment horizon to allow their investment to grow, and during the market or looking at the market downturns and recoveries, uh, see how the stock market are prone to sudden loss value for different reasons. Two things to consider, right? So now I'm going to focus on how this market contraction or this market downturn with respect on different asset class. Okay, so this course looked at the downturns and recovery with respect of some asset class, such as bonds, stocks, some other asset classes, and with some sample portfolio, and to get and to look at the correlations of different assets with the broader market. Again, correlation does or causality doesn't mean correlation, but it can give you some confidence. Okay, when you look and when you're able to see a set of financial statement, or when you're able to see the market trend, uh, or the broad market, what are the things that you should do, right? Again, this is more for decision making, right? This is more for decision making. Now, looking at the bond yields during recession, there are driven factors such as the demand, the supply and demand for loanable funds, the monetary policy, and expected inflation. So the Federal Reserve has in its primary tool is the discount rate, the rate at which was either the rate in which the Federal Reserve charge bank for short-term loans, or is the rate used in the discount cash flow, or in its expected discount cash flow. Okay, yeah, or it is expected discount cash flow, which is an evaluation method that allow to know an investment the current value based on its expected future cash flow. Okay, so the discount cash flow, where we have this discount cash flow. Okay, so when you look at the discount here, discount rate defined exactly. But when we have here the discount rate, either the interest rate that the Federal Reserve charge banks for shorter loans, or the rate used to discount future cash flow in discounted cash flow analysis. Okay, is the rate used to discount future cash flow. Okay, discount future cash flow in the discount cash flow analysis. So this discount cash flow is just an evaluation method to determine the current value of an investment based on its expected future cash flow. Okay. Uh, so now things are starting to make a little bit. It's starting to make more sense. See, things are starting to make sense of this, because since the discount cash flow, or the discount rate, is either the interest rate that the Federal Reserve charge banks for shorter loans, or the rate used to know the value of an investment based on its future expected cash flow, okay, or the discount future cash flow. So the cash flow is the movement of money in and out of a company. So to be more specific about how all of this mean, okay, the discount rate is either the interest rate that the Federal Reserve charge banks for shorter loans, or the rate used to discount future cash flow, or the rate used to know the value of an investment today based on its expected movement of money in and out of a company. Okay. Uh, this discount cash flow is might be something out of the scope for this. Okay, might be quite out of the scope of this. Uh, because we're going to focus is on cash flow, something I mentioned, and then I look at that cash flow can be categorized in financing, investment, and operations. And to me, it's like okay, but I need to know first where all this data come from. So we have here the beginner guide to financial statement, and it was pretty illustrative because it tells us well if you're able to read a nutritional label or a baseball box score or a soccer box score, you can know how to read basic part of a financial statement. If you can follow a recipe or apply for a loan, which is something time consuming, you can learn the basic of accounting. And the basics, they're not difficult. They're rocket science. So this section will gonna teach me is how to understand this basic part of financial statement, how to read them, just like a CPR class teach you how to perform basic cardiopulmonary resuscitation. So be able to read be able to read this basic part of financial statement won't train you as an accountant, just like a CPR course won't make you a cardiac doctor, but it can give you confidence to be able to look at a set of financial statements and to make sense of them. So the financial statements, they show you the money, right? From the Cuba Gooding Jr. Immortal Lines from Jerry Maguire, show me the money. That is financial statement. That's what financial statements do. So they show you the money, the how much money or where a company money came from, where is it now, and where it went. So for financial statements, there are four financial statements. So balance account, income statement, cash flow, and statement of shareholders. So the first show is what a company owns and what it owns at a period of time. Income statement is uh, income statement uh, show you how much money a company made and spent over a period of time. Cash flow show you the movement of money between the company and the outside world, and the statement of shareholders show you the change of interest. Uh, show you the show change in the interest of company shareholders. Show you show change in the interest of company shareholders. So let's go to look at the first three. Balance sheet. So they show you a detailed information about the company assets, liabilities, and shareholders' equity. So assets are anything that a company owns that has value. Either they can be used to be sold, or um, they can either be sold exactly. So they can be either be sold or can be used to make uh, products and services that can be sold, right? Okay, so it is used by the company to make products and services that can be sold. So you have tangible assets, whether it's your building, construction. So, for example, it's like truck, land, equipment, inventory, physical assets. In my case, physical assets are the keyboard, mouse, motherboard, mobile, and intangible assets, whether it's in patents, uh, and trademarks, right? So, for example, what I'm doing right now is to creating this particular intangible assets, right? As so, see myself as as a trademark or creating myself in my own niche, right? Cash is another type of investment, and investments that a company make is also assets. Then you have liability, which is the amount of money that a company owns to others. This can include all kind of obligations like money borrowed from a bank to launch any product, rent for use a building, the money you own to suppliers, payroll a company owns to its employees, environmental cleanup costs. So, for example, something that happened on Ohio, okay, toxic brain broke down 2 days before Ohio derailment workers, all right, and they call EPA. EPA is the Environmental Protection Agency. I was close. I was close. Okay. So yeah, environmental cleanup costs or pay taxes right? And also things or obligations to provide service in the future are liabilities. To provide good or service on the future are liabilities. So, for example, e-commerce. So when you ask for a product on Amazon, all right, let's say you want to buy a dildo for that. Why would you do that? Who knows, right? Because you want to. You feel curious. Naughty, naughty, naughty. Anyway, so you bought that, and to Amazon that's a liability because until you receive that good, uh, they have that on their liabilities. Okay, most of the times are things that they so even in their logistics they have all of the things that works pretty well, like a well-oiled machine. Okay, and then you have a shareholders equity. So it is something called net worth or capital, and if the money that left, if all the company assets were liquidated and pay off all of its liabilities. So the money, that's the money, that money belongs to the shareholders and owners of the company. So I look at this particular equation, and you have assets, liabilities, and shareholders. Most of the time, you will find on a balance sheet on the left side is the company asset listed, and on the right side you have is the liabilities and shareholders equity. Or on top, you can find is all of their company asset listed, followed by the liabilities and shareholders equity, much like Yahoo Finance show that data. Okay, so for example, when I look at now uh, Coca-Cola from Yahoo Finance. Okay, Mm-hmm. So looking at the financial, we have the balance sheets. Okay. So, for example, Yahoo Finance, they have a balance sheet layout. On top, they list all of their assets in followed by the total liabilities and equity and shareholders' equity, right? So the total assets are generally listed by how quickly you can convert that into cash. So you have current assets and non-current assets, where current assets are things that you expect to convert into cash within a year. So, for example, inventory or non-current cash or non-current assets. There are things that you don't expect to be sold in a year, or that is hard to do that. That will take longer to do that. Inside of this non-current asset, we have fixed, something that they don't show here. You have fixed assets. Let me look at this. So you have is fixed assets. Fixed assets. So fixed assets are those assets used to operate the business but that are not available for sale. Exactly. So fixed assets. And there are assets that are used to operate your business and they're not for sale. So for example, office furniture, trucks, and in my case is the laptop, keyboard, mouse, my mobile, and the internet. There are no negotiable. Yeah, there are no negotiable. And then you have is a liability that are generally liabilities are generally listed by their due dates. So liabilities are either current or long term. So current liabilities are obligations that a company expect to pay off within a year, whereas the long terms do more than 1 year. And and shareholders' equity is the amount of and the shareholders' equity is the amount of is the amount investors or is the amount owner invest in the company stocks plus or minus company earnings or losses since inception. So sometimes companies distribute earnings instead of retaining them. And these distributions are called dividends. Okay. So these distributions are called dividends. And a balance sheet shows a snapshot to recap of this. So the balance sheet shows you a snapshot of a company assets, liabilities, and shareholders' equity at the end of a reporting period. And it does not show the flow in and out of the accounts during the period, right? It doesn't show the flow into and out of account during the period. So okay, so that's the balance sheet, right? So balance sheet show you a snapshot of the company assets, liabilities, and shareholders' equity at a period of time, or at the end of a reporting period. At the end of a reporting period, and that reporting period can be annually or quarterly. But I show you that. Okay, we make a let make. I'm gonna make a pause here. Mhm. All right. So let me keep reading about is the income statement. So an income statement is a report that shows how much revenue a company earned over a specific time period. How much a company made over a specific time period. And the cost and expense associated with earning that revenue. Okay? So an income statement is a report that shows how much revenue a company earned over a specific period of time, usually for a year or some portion of the year, quarterly, you name it. For example, here they have that income statements organized annually or quarterly. Okay, annually or quarterly. Dividend. KO announced a cash dividend of 0.46 with an X date, March 16, 2023. This is something that I was looking, alright? So most of the time, or sometimes, that's on the, uh, yeah, on the shareholders' equity, on assets, okay? On shareholders' equity, on shareholders' equity. That since shareholders' equity is the amount investors is since stock since shareholders' equity is the amount invest is the amount owner invests in a company stocks plus plus company earning or losses, okay, since its inception. Mhm. It's like this. So since shareholders equity since shareholders equity is the amount owner invest, okay, since shareholders equity is the amount owner invest in the company assets plus or minus the company earning or losses since inception. Sometimes company distribute earning rather than retain them, retaining them. So these distributions are called dividends. So they're giving away, they're going to distribute that. So Coca-Cola, they're going to distribute earnings. So they're going to distribute earnings. Okay. Mhm. An income statement. An income statement is a report, and just to understand more about this income statement, right? So an income statement is a report that shows how much revenue a company earned over a specific time period, usually a year or some portion of a year, quarterly. An income statement also shows the cost and expense associated with earning that revenue. So in other words, income statements show you how much money a company made over a specific period of time, typically annually or quarterly, and the expense and cost associated with those earnings. Or the expense of cost uh, associated with earning that revenue. Exactly, it's with the earning. Okay. So the literal bottom line of the statement usually show the company net earning on losses. This tells you how much the company earned or lost over the period. So you have the bottom line of the statement usually show the company net earning or losses. The bottom line of this statement, this income statement, show you the company net earning or losses and how much the company earned or lost over a period of time. So when I look at the income statement, expand all, collapse all. So they show you if the all numbers in thousand. So Coca-Cola quarterly make this huge amount of money. And annually make this amount of money. Even though during the pandemic there was even an increase in the consumption of Coca-Cola. Well, there's an increase in the consumption of Coca-Cola. Well, and they recovered from that period. It's like, well, they recover very, very well. It's like, what? Oh my god. Interesting. Very, very interesting. So the income statement show how much money a company earned over a specific time period, usually annually or quarterly, and the associated expense and cost with earning that revenue. So the literal bottom line of the statement usually show a company net earning or losses. The literal, the literal, yeah, the literal bottom line. Okay. I don't know how to read that. But go ahead. But this tells you how much the company earned or lost over the period. Income statement also report earning per share, and this calculation tells you how much a money shareholder will receive if the company decides to distribute all of the net earning for the period. So if the company decides to distribute all of their earnings, all of the net earning, not total gross, of course. So EPS is this calculation that uh, is a calculation tells you how much money a company tells you how much money a shareholder will receive if a company decides to distribute all the net earning from the period. Mhm. If I look at the EPS, the earning per share, basic EPS, okay, basic EPS, diluted EPS, in quarterly, okay, they will receive that amount, right? All numbers in thousands. Okay. Mhm. All right. So, income statements show you how much money a company earned over a period of time, usually annually or yearly, over a over a specific time period. Okay, I would like to use that word as well. So, income statements show you how much money a company earned over a specific time period, generally annually or quarterly, in the expense and cost associated with earning those or with earning that revenue. Okay, so the little bottom line of the statement usually show the company net earning or losses. The bottom line of the statement show you the company net earnings or losses, and this tells you how much the company earned or lost over the period. Income statement also reports earning per share. Is this a calculation that tells how much money a shareholder will receive if a company decides to distribute all of its net earnings for that period? And companies almost never distribute all of their earnings. Usually they're reinvesting in the business. You know, usually they reinvest them in the business. So to understand how income statements are set up, think of them as a set of stairs or a ladder. You start at the top with the total amount of sales made during an accounting period, and then you go down one step at a time. In each step, you make a deduction of certain costs or other operating expense associated with earning the revenue. At the bottom of this stair, after deducting all expense, you learn how much the company actually earned or lost during the accounting period. And people often call this the bottom line. In Spanish, is balance final. Mhm. So that'll be all for this video. Take care. Bye bye.